So I want you to picture you're sitting in the cockpit of this massive, just gigantic twin-engine jumbo jet.
Okay, I'm picturing it.
Right. And you're at the controls, you're looking down at the dashboard, and you realize something incredibly weird is happening with the propulsion.
Like a malfunction?
Kind of, yeah. Like engine 1 is running white hot. I mean, it is generating maximum record-breaking thrust. It's essentially defying the standard laws of aerodynamics for a plane this heavy.
Pushing the whole thing forward.
Exactly. But then you look at engine 2 and it's sputtering a bit. Like it's still climbing back to cruising altitude. You can hear the horsepower roaring, but it's hitting heavy turbulence. It's dragging a bit, pulling the whole plane in this slightly unpredictable direction.
That is a very specific analogy.
Right, but that twin engine jet, that is Las Vegas Sands.
Ah, I see where you're going with this. LVS.
LVS, exactly.
Yeah.
And looking at their Q1 2026 earnings, Engine 1, which is Singapore, just hit an operational margin that frankly shouldn't be physically possible for a brick and mortar building.
It's wild. We're talking about an EBITDA margin of 53% at Marina Bay Sands.
53%. I mean, that's just, it's nuts.
It really is. That 53% figure is the kind of metric that literally forces you to completely recalibrate your valuation models.
Yeah.
Because when you're operating at this kind of massive multi-billion-dollar multinational scale, your engines rarely run in perfect sync.
Right. Something is always dragging.
Exactly. But the sheer cash generation happening in Singapore right now, it is single-handedly carrying the entire thesis for the stock.
Which is crazy to think about.
It is. I mean, we're looking at $788 million in pure operational cash flow from that one single property in just 3 months.
And that is exactly what we are stripping down today. Welcome to a special Talk Tickers edition of our deep dive.
Glad to be here for it.
So, our mission today for you listening, whether you are currently managing a position in Las Vegas Sands, ticker symbol LVS, or you're just on the sidelines trying to gauge the temperature of the global luxury consumer, you can't just look at the consolidated revenue line.
No, the top line number hides all the actual drama.
It totally does. The real narrative is buried in the operational mechanics, right? The shifting psychology of the VIP bettor and this massive capital allocation strategy that management is quietly executing.
Which we're going to get into because it's a masterclass.
We absolutely are. Our Talk Tickers playbook is all about being data forward, translating the Wall Street jargon into plain language, taking a firm opinion on the stock, and giving you actionable takeaways.
Getting right to the bottom line.
Exactly. But I want to start by pressure testing that Singapore margin because it feels anomalous.
Anomalous? How?
Well, we're talking about a physical property here. They have to pay thousands of dealers, culinary staff, security they have to keep a massive tropical infrastructure running 24/7.
AC bills in Singapore are no joke.
Right. So achieving a 53% margin in a high fixed cost, labor-intensive business just seems completely disconnected from reality.
It feels disconnected if you analyze it like a traditional hospitality business, sure.
But a casino is different.
Very different. Marina Bay Sands is currently demonstrating the absolute ceiling of what we call operational leverage in the integrated resort model.
Okay, unpack operational leverage for us, plain language.
Right, so the fixed costs to keep a property of that massive scale running are astronomical. The baseline just to keep the lights on and the doors open, the break even, is huge.
You got to pay the staff whether one guy shows up or 10,000.
Exactly. But once they clear that hurdle, once they cover that baseline, the incremental margins on the very next dollar wagered are staggering.
Because the infrastructure is already paid for.
Right. Think about it. If a high roller drops $1 million at a baccarat table in an hour, the variable cost to the casino to capture that specific revenue is essentially zero.
They didn't have to hire an extra dealer for that hour.
Nope. They didn't have to cool an extra room. They maybe gave them a free drink, right? So that entire $1 million minus taxes basically falls straight to the bottom line.
So wait, it's performing more like an enterprise software company at this stage?
The cash flow dynamics are remarkably similar, yeah.
That's wild.
It is. When you have a physical property running at absolute peak utilization, the profitability curve goes exponential. Every additional dollar of volume is pure profit.
And here's the catcher. It requires the volume to actually be there.
It does. And it requires the consumer behavior to align perfectly with the house advantage.
Right, which brings up the obvious risk and the drag we were talking about on Engine 2. Let's pivot and look at Macau.
Yeah, let's look at Macau.
Because the Q1 data there presents a very different picture. the Macau operations generated $633 million in EBITDA.
Right.
Now, for anyone tracking this, management has been heavily telegraphing a $700 million quarterly run rate target.
They've been very vocal about that target.
Right, so missing that by nearly $70 million, that isn't a rounding error.
No, it's a real miss.
So my immediate read as an investor is that the vaunted Macau recovery is stalling out, or maybe they're losing market share to Galaxy or Wynn. Am I misreading the severity of this miss?
You're not misreading the headline, but you have to separate the fundamental demand from the mathematical variance.
Okay, explain that.
The headline miss looks concerning, absolutely. But when you dig into the actual segment data, the underlying behavior, the fundamental business engine, is actually firing on all cylinders.
Really? No. Even with a $70 million miss?
Yes. Look at the mass market revenue share. It hit 25.7%. That's the strongest performance they've had since early 2024.
Okay, so the regular everyday tourists are showing up and spending.
Exactly. The issue was entirely isolated in the rolling segment.
The VIPs. The whales.
The high-end play, right.
Yeah.
And specifically, it wasn't a lack of whales, it was an issue of hold.
Okay, stop right there. Let's translate hold for the listener who maybe doesn't spend their weekends studying casino accounting.
Fair enough. So hold is basically the casino's actual win rate versus their mathematically expected win rate.
So it's basically the house edge playing out in real life.
Right. So this is purely a statistical anomaly we're seeing in Macau.
Wait, so the players showed up, the volume of money was actually there, but the house just got hit with a bad run of cards?
That is exactly what happened. The math is brutal in the short term.
Wow. Well,
every game has a strict statistical probability, right? The house edge. And that dictates the expected hold over an infinite timeline.
If you flip a coin a million times, it's 50-50.
Exactly. But a 90-day financial quarter, that is a microscopic window in the context of statistical variance.
So you could just have a few guys get really lucky over a weekend.
Exactly. Management actually quantified this. They said that this lower than expected actual hold cost them $15 million in EBITDA directly.
Just from bad luck.
Just from bad variance. And that dragged the Macau margin down to 29.6%.
That is just, it's wild to think that a few high-limit players hitting a hot streak on the baccarat tables can literally wipe out $15 million in bottom-line cash.
It's the reality of the business.
And drag down the operating margin by 200 basis points for a multi-billion-dollar publicly traded corporation.
It completely highlights the inherent volatility of the business model. You just cannot control if a player gets incredibly lucky on a Saturday night.
Right.
But, and this is the actionable part for the investor, as an investor, you have to value the business on normalized hold.
Meaning, assume the math eventually works out in the casino's favor.
Exactly. The volume, the actual amount of money pushed across the tables was completely in line with their growth models. The players were there.
So penalizing the stock for a 90-day mathematical fluctuation is kind of short-sighted.
It ignores the reality that the house always converges on the expected probability eventually. The house always wins, right?
Yep.
It just might take more than 90 days to show up on the balance sheet.
Okay, that makes the Macau dynamic much easier to digest. But it also perfectly tees up the absolute strangest behavioral shift discussed on this earnings call.
Oh, the barbell.
Yes. Because if Macau suffered from bad variance, Singapore seems to be thriving on a completely unprecedented type of volatility.
It really does.
Let's look at the numbers. Management reported $18 billion in rolling chip volume in Singapore for the quarter.
18 billion.
18 billion. And they explicitly described the betting behavior driving this massive number as a barbell.
A very specific term to use.
Right. When I hear barbell strategy, I immediately think of a bond portfolio.
Right. Nassim Taleb stuff.
Exactly. You have ultra-safe treasuries anchoring one end of your portfolio, and then highly speculative distressed debt or options on the other end with absolute nothing in the middle. Is that the same psychology playing out on the casino floor right now?
It is the exact same psychology, and it is fundamentally altering the risk profile of the casino's entire revenue stream.
How so?
Well, in the past, the VIP segment was relatively predictable, right?
A bunch of rich guys playing standard baccarat.
Exactly. You had high net worth individuals playing traditional baccarat, betting strictly on the player or the banker. And the house edge on those base bets is razor thin. We're talking around 1 to 1.2%.
Okay, so they're the index fund investors of the casino world.
That's a great way to put it.
Like They deploy massive capital, they're betting hundreds of thousands a hand, but they're playing the most mathematically sound, low volatility game available to them.
Right. They grind out hours and hours of play. They generate massive rolling volume, lots of money moving back and forth, but with very predictable outcomes for the house.
Because of the low edge.
Exactly. So that is one end of the barbell, the safe end. But the other end is what management is tracking so closely right now and why they brought it up on the call.
The side bets.
Yes. We are seeing the rise of highly volatile VIPs who are essentially ignoring that mathematically safe base game, and they are aggressively targeting high payout side bets.
Okay, explain these side bets for someone who hasn't been in a high limit room. These are bets where the player is predicting like a specific pair of cards on the deal or an exact numerical tie, right?
Player gets a pair of eights, or it's a tie at 6. Very specific outcomes.
And the payouts on those are huge, right? Like maybe 11-1 or 30-1.
The payouts are massive, but the mathematical odds are terrible for the player. The house edge on those side bets can easily clear 10 or 15%.
Wow. So compared to the 1% on the base game, the disparity is massive.
It's huge. And what's crazy is you're seeing players wiring in millions of dollars and playing these terrible odds side bets with the aggression of like crypto options traders.
That is such a good analogy. They just want the massive instant spike.
Exactly. They want the instant dopamine spike of a 30-1 payout. They are actively choosing extreme volatility and terrible math over the slow grind of the base game.
But why? I mean, why are billionaires, people who presumably built their incredible wealth through highly calculated risk management in their businesses, why are they suddenly throwing capital at mathematically irrational side bets?
It's fascinating, isn't it? I think it reflects a broader gamification of risk that we're seeing across all asset classes globally.
The Robin Hood-ification of the VIP room.
Basically, yeah. For this specific demographic, the actual utility of money is different. Winning a standard 1-to-1 bet on $1 million. It doesn't move the needle for them psychologically anymore.
$1 million doesn't change their life.
Exactly. They are seeking asymmetric returns, even in a closed system like a casino where the odds are definitively mathematically stacked against them.
They know it's a bad bet.
They absolutely know it's a bad bet. They are paying a massive premium via that high house edge just for the entertainment value of the volatility itself.
Which explains how the theoretical hold in Singapore settled at a very elevated 3.6%.
Right, because the house is keeping more of the money over time due to those bad bets.
And this is where I put my risk manager hat on. That strategy has to be absolutely terrifying for the casino's finance department.
Oh, it causes sleepless nights for sure.
Right. Because if a whale drops $10 million on a side bet and they somehow hit that 30-1 long shot, the casino is suddenly on the hook for a $300 million payout on a single hand of cards.
Yep. The house edge is higher, but the standard deviation is off the charts.
The variance could bankrupt a smaller operator.
Absolutely. And that is the trade-off management is making. That 53% margin we talked about, it is heavily subsidized by the structural advantage of those side bets.
But it bakes massive quarterly variance into the business.
Exactly. The house is essentially absorbing the volatility that these billionaires crave.
They are acting as the counterparty to the billionaires' options trades.
Perfect way to frame it. Over a 5-year timeline, the casino prints money on those bets. They literally can't lose over the long term.
But in any given 90-day window.
But in a 90-day earnings window, a lucky side bet junkie can completely wreck the entire earnings report for Las Vegas Sands.
It's just a fascinating evolution of the luxury consumer.
It really is.
But let's shift away from the ultra-wealthy whales for a second. Let's look at the broader consumer base, because the data coming out of Macau on the mass market side feels equally contradictory to the broader global narrative right now.
The mass market numbers were incredible.
Right. I'm looking at the transcript, and there is a 37% growth in Macau tenant retail sales. And management noted that's driven heavily by jewelry and watches.
Huge numbers.
And alongside that, a 31% growth in the slot and electronic table game segments.
Which is the pure mass market mom and pop player.
Right. And those two data points, 37% retail growth and 31% slot growth, to me, those are the strongest bullish indicators in the entire transcript.
Especially when you overlay them against the macroeconomic backdrop.
Exactly. Because if you turn on CNBC or Bloomberg right now, the dominant pervasive narrative is that the Chinese consumer is entirely tapped out.
That's all we hear about.
Right. We are hearing nonstop about the property sector crisis, massive youth unemployment, and a huge contraction in discretionary spending across mainland China.
It's supposedly a dire situation.
Yet LVS is printing all-time high quarterly retail numbers, selling Rolexes and Cartier on the Putai Strip. How do we reconcile this? Like, is the macro data just wrong?
The macro data isn't wrong for the broader population, but you have to understand the specific demographic LVS is catering to. The premium mass consumer, which is LVS's bread and butter, is operating in a completely different economic reality than the average citizen.
So it's a tale of two economies?
Yes. We are witnessing a stark, textbook K-shaped recovery in the region.
Okay, K-shaped meaning the top goes up while the bottom goes down.
Exactly. The upper middle class and wealthy business owners are largely insulated from the domestic property slump. They still have significant liquidity.
And it seems like buying high-end Swiss watches in Macau isn't just about conspicuous consumption, right?
Oh, definitely not.
For a lot of these consumers, luxury watches function almost as a shadow currency or a highly mobile store of value. It's almost a form of capital preservation masquerading as a retail purchase.
That is a critical nuance that a lot of retail investors miss. When domestic investment avenues in mainland China look risky or are heavily constrained by regulations, capital naturally seeks alternative stores of value.
Right. You can't buy real estate easily. Stocks are down.
So high-end jewelry and horology fit that bill perfectly. You can wear $100,000 on your wrist across a border. So that 37% retail growth isn't just a sign of frivolous vacation spending. It's an economic indicator of where regional wealth is being parked right now.
Wow, that makes perfect sense. Okay, but there was another point management made about the macro environment that I found really, really hard to swallow.
That's right.
They explicitly cited rising geopolitical tensions in the Middle East and the soaring cost of global airfare as positive tailwinds for their business.
Ah, yes, the geopolitical angle.
I have never, in my years of reading these transcripts, seen a company frame global instability as a competitive advantage. Usually the first thing that dies when international conflict spikes is the luxury travel sector.
It is deeply counterintuitive, I agree.
Yeah.
But it relies on a concept called short-haul destination appeal.
Yeah.
And it actually tracks perfectly with historical travel data during periods of crisis.
Okay, walk me through the mechanics of that. Because to the average person, a crisis in the Middle East driving a higher EBITDA margin in Macau sounds like madness.
Right. So consider the risk adjustment calculus of a wealthy traveler based in, say, Shanghai or Beijing right now.
Okay.
3 years ago, their primary luxury vacation for the year might have been a 2-week trip to Paris or London or maybe Dubai.
The classic luxury destinations.
Exactly.
Right.
But today, the geopolitical map is highly fractured. Airspace restrictions over Russia and the Middle East require massive rerouting for commercial flights.
Which pushes a 10-hour flight to 14 hours.
Exactly. And the cost of jet fuel has driven premium cabin pricing through the roof. And frankly, beyond the cost, there is just a pervasive generalized anxiety about traveling far from home when the news cycle is this dark.
The friction of long-haul travel has just become too high, both financially and psychologically.
Precisely. When global anxiety spikes, the desired travel radius for wealthy individuals shrinks dramatically. They still want the ultra-luxury experience, the high-end culinary options, the shopping, the gaming, but they want it in a highly secure, predictable environment that doesn't require crossing multiple volatile time zones.
So they default to Macau or Singapore.
Yes.
Because they get the exact same luxury infrastructure, the same Michelin-starred restaurants, the same retail brands, but it's just a 3-hour domestic flight or a highly secure regional hop.
It is the geopolitical consolidation of regional wealth. LVS has effectively built these fortified luxury safe havens.
That's a great term. Fortified luxury safe haven.
Right. And the more unpredictable the rest of the world becomes, the wider their regional economic moat grows.
Mm-hmm.
They're actively capturing all the capital that would have historically flowed out to Europe or North America.
It's a brilliant, if slightly cynical, reality of the current market.
It's just the data playing out.
Right. But capturing that capital requires the physical infrastructure to support it, which brings us to management's guidance and their massive capital allocation strategy.
Let's talk about the CapEx.
Yes, I want to look at the capital expenditures because they dropped some massive numbers on this call. The most glaring one to me is the total room and suite refresh planned for the Venetian Macau.
Oh yeah, starting in Q3 of 2026.
And stretching all the way to early 2028.
The Great Renovation.
That's what we're calling it. And this is traditionally the point in the cycle where retail investors get very, very nervous.
And rightfully so. It's a huge disruption.
The Venetian is their absolute flagship property. Taking vast swaths of it offline for over a year sounds like a logistical nightmare.
It does.
I mean, in the hospitality business, renovations usually mean plunging RevPay revenue per available room and a mass exodus of your most demanding clients to a competitor down the street, because who wants to sleep next to a jackhammer?
Nobody. Especially not a VIP.
Exactly. So how do they navigate a gut renovation of a flagship property without bleeding market share to Galaxy or Wynn?
If they were a standalone operator with a single property, it would be devastating. It would crush their earnings.
They'd have to slash room rates.
Exactly. But this is where LVS flexes its ultimate structural advantage on the Cotai Strip. Massive interconnected scale.
Right.
They control a contiguous ecosystem there. You have the Venetian, the Londoner, the Parisian, the Plaza, and the Four Seasons. We are talking about roughly 12,000 rooms, all linked by air-conditioned walkways.
It's practically a city indoors.
It is.
Yeah.
So they can treat the entire strip as a single fungible inventory pool.
Oh, I see.
When they pull a block of, say, 500 suites offline at the Venetian for construction, they don't turn those guests away. They dynamically route that demand into newly renovated product at the Londoner, or they upgrade them into the Four Seasons.
They can just play a high-stakes game of logistical musical chairs.
Precisely. They are shifting casino hosts and high-value players away from the noise and the dust without ever letting them leave the LVS ecosystem.
So the scale absorbs the shock.
Yes, scale is their shock absorber.
Okay, that definitely mitigates the risk of the Venetian project. But they also casually mentioned a $500 million annual run rate just for maintenance capex across the portfolio.
That's a big number for maintenance.
Right. Management literally said, quote, depreciation is real in our business, end quote. But $500 million just to patch the carpets and fix the wallpaper annually.
You have to view luxury depreciation as an arms race, not a standard accounting metric.
Explain that.
This isn't a software company where maintenance capex just means upgrading AWS server instances or patching code. This is a physical product experiencing hyper-accelerated wear and tear.
Because it's open 24/7.
Right. You have tens of thousands of people walking across custom-milled carpets daily. You have chain-smoking VIPs burning expensive upholstery. You have the ambient humidity in the salt air of Macau and Singapore constantly degrading the physical plant on the outside.
Okay, so things break down fast. But still, $500 million.
The tolerance for a tired product at this price point is literally zero. If a player dropping millions of dollars in rolling volume sees peeling wallpaper in the hallway or a scuffed baccarat table, they don't complain. They simply walk across the street to a newer casino.
The luxury consumer is entirely unsentimental.
Exactly. That $500 million is not a growth initiative. It is the defensive toll required just to tread water and maintain pricing power.
It's the cost of staying relevant.
Yes. Because if you underinvest in maintenance capex in this specific industry, the decline is exponential. Once a property loses its premium sheen, it attracts a lower tier of customer, which degrades the experience further, which drives away the remaining premium players.
It's a death spiral.
Management is spending $500 million a year just to prevent that death spiral.
Got it. But they are also deploying massive capital for aggressive growth, specifically in Singapore with what they're calling IR2 Integrated Resort 2.
The New Delhi, yeah.
Right. They are building an arena, ultra high-end suites, and aiming for what they called the most luxurious hotel in the world.
Ambitious.
Very. But the metric that jumped out to me as a talk tickers guy was their target of a 20% return on invested capital, ROIC.
20% is huge.
A 20% ROIC on physical ground-up real estate development is an aggressively confident projection. It means for every $1 billion they pour into the ground, they expect it to yield $200 million in pure profit annually.
Essentially paying for itself in 5 years.
Exactly. The only way you underwrite a project with those kind of returns is if you believe there is massive, completely unfulfilled demand at the absolute apex of the wealth spectrum.
And that is exactly what the data is telling them.
From the current property.
Right. Remember that 53% margin at the existing Marina Bay Sands property we talked about at the top of the show?
Yeah.
That indicates that they are actually turning away highly profitable demand because they physically do not have enough ultra-premium suites to house all the billionaires who want to come.
They literally can't take their money fast enough.
IR2 is designed to capture the overflow of that barbell betting strategy we discussed earlier. They need more rooms for the side bet junkies.
Okay, but capturing that new demand and servicing the premium mass segment in Macau is driving up costs elsewhere. And this is a big red flag for some analysts. Management was very transparent that their operating expenses, OPEX, are rising significantly.
Yes, the headcount increases.
Right, because they are aggressively increasing headcount in Macau. And historically, Wall Street hates rising OPEX. Margins compress, analysts downgrade the stock, and retail investors panic sell.
The instinct to sell on rising OPEX is strong. But in this specific context, I really think it would be a mistake.
Why?
You have to look at what they were actually buying with that payroll increase. The Macau market is undergoing a structural paradigm shift right now.
The end of the junket era.
Exactly. For a decade, the volume in Macau was driven by junket operators. These were third-party middlemen who brought the VIPs to the casino. They handled the credit, they handled the logistics, and they took a massive cut of the revenue.
So the junkets were essentially an outsourced, variable cost sales force for the casino.
Precisely.
Yeah.
You only paid them if they brought a player. But that junket model has been effectively dismantled by regulators over the last few years.
Right, the government cracked down hard on that.
So now, LVS has to transition to a direct relationship model, focusing on the premium mass segment. And to win that customer, you cannot rely on a middleman anymore. You have to provide the hospitality infrastructure directly.
You have to do the heavy lifting yourself.
You need world-class concierges, dedicated casino hosts, massive culinary teams, and personalized luxury transport fleets.
So they are taking what used to be a variable cost, paying the junket a commission only when the player showed up, and converting it into a massive fixed OPEX structure. They're literally hiring armies of luxury hospitality staff.
It is the J-curve of operational investment.
The J-curve, meaning it goes down before it goes up.
Exactly. You absorb the pain of the OPEX hit today to build a best-in-class service infrastructure. The margins compress temporarily, but once that infrastructure is in place and the premium mass revenue scales up into it,
Then the leverage kicks in.
the operating leverage we saw in Singapore kicks in, the fixed costs stabilize, and the incremental revenue falls straight to the bottom line. It's the exact same playbook they successfully executed at MBS. They are just in the messy middle of the transition in Macau right now.
Okay, framing it like a J-curve makes the margin compression much more palatable for a long-term holder.
It's an investment, not a waste.
Right. But let's bring this all back to the ultimate arbiter of value for the retail investor: capital returns.
The best part.
Because management is spending billions on renovations, billions on new towers in Singapore, and billions on payroll. Yet somehow they are still running one of the most aggressive capital return programs in the entire hospitality sector.
The financial engineering happening at Las Vegas Sands right now is arguably the most compelling part of the entire thesis.
Let's look at the raw numbers here. In Q1 alone, they repurchased $740 million of their own stock, and they paid a 30-cent per share dividend.
That's in one quarter.
1 quarter. But the metric that truly defines their strategy is a multi-year view. Over the last 10 quarters, LVS has bought back 14.3% of its outstanding shares.
They have completely vaporized over 14% of the company's equity base in 2.5 years.
I want to really dig into the mechanics of this because I think a lot of retail investors see buyback announcements and gloss over them. They see it as corporate financial maneuvering that doesn't really impact their specific E-Trade or Schwab account.
It impacts it massively.
Right. So if I am sitting at home holding 100 shares of LVS, how does the company taking $740 million in cash and giving it to institutional hedge funds in exchange for retiring their shares actually benefit my position?
It is the purest form of value accretion. And it is the exact same playbook Tim Cook used to turn Apple into a compounding machine over the last decade.
It all comes down to earnings per share.
It all comes down to the math of earnings per share, or EPS.
Okay, walk me through the math for LVS, plain language.
Sure. Let's say you own 100 shares of LVS. You basically own a fractional claim on the total free cash flow the business generates, right?
Like owning a slice of pizza.
Exactly. If the business generates $1 billion in profit and there are 1 billion shares outstanding, your claim is exactly $1 per share.
Easy math.
Now, Imagine the broader macroeconomic environment stalls completely. The Macau recovery slows down, Singapore growth flattens out, and the next year, the company still only generates exactly $1 billion in profit. Zero top-line growth.
In a normal scenario, zero growth means a stagnant stock price. The market assigns a multiple, and if the earnings don't grow, the stock goes nowhere.
But if management has spent the year aggressively buying back and retiring 14% of the outstanding float, there are no longer a billion shares claiming that profit. There are only 860 million shares. So total profit of the company didn't change by a single penny. But your 100 shares now represent a mathematically larger percentage of the total equity.
My slice of the pizza got bigger, even though the pizza stayed the same size.
Yes. The earnings per share artificially expands.
So the company is effectively forcing my equity to become more valuable without having to invent a new product, open a new market, or rely on macro tailwinds. They are manufacturing EPS growth purely through capital structure optimization.
Exactly. And the reason this is so powerful for LVS right now is because they are funding these massive buybacks purely out of the free cash flow generated by those 53% margins in Singapore and the premium mass growth in Macau.
They aren't borrowing money to do this.
Right. They are not leveraging the balance sheet with toxic debt to fund this buyback. They are taking operational excess and systematically shrinking the float.
It creates a massive structural floor under the stock price.
It really does.
Even if the market gets spooked and applies a lower valuation multiple to the casino sector due to macro fears, the sheer reduction in share count protects the EPS.
It is a guaranteed return on investment for the remaining shareholders. When management looks at their weighted average cost of capital, they clearly believe that buying their own stock at current valuations yields a better, lower risk return than aggressively deploying that capital into unproven new markets.
They're betting on themselves.
They are betting on themselves, and they're shrinking the pie so your slice gets larger.
Okay, we have unpacked a tremendous amount of data today. We've torn down the mechanics of a 53% margin, the statistical variance dragging down Macau, the wild barbell betting psychology of the VIP segment, and the geopolitical anxieties driving short-haul luxury travel.
We covered a lot of ground.
We did. We
Right.
mapped out the logistical musical chairs of the CapEx cycle and the EPS expansion driven by the buyback machine. Let's synthesize all of this into a definitive, actionable bottom line for the investor holding or looking at this stock.
Based on the underlying mechanics revealed in this transcript, the stance has to be definitively bullish. The short-term turbulence is obscuring a profoundly strong fundamental business model.
Give me the core pillars of that bullish thesis. If I'm taking notes, what are the three things I write down?
Okay, 3 takeaways that drive the valuation. First, Singapore proves that the integrated resort model, when operating at peak utilization, can generate software-like cash flow margins. That 53% figure is the proof of concept for the entire enterprise.
Engine 1 is proving the design works.
Exactly. Second, the 37% retail growth and 31% slot growth in Macau absolutely validate that the premium Chinese consumer is resilient. They are insulated from broader macro weakness, and they are utilizing LVS properties as a regional safe haven for capital deployment.
And the third pillar is the financial engineering.
The buyback. The relentless reduction of the share count by over 14% means that the cash flow generated by those first two pillars is being concentrated into fewer and fewer hands. As an investor, your ownership stake and your claim on that cash flow is mathematically growing every single quarter you hold the stock.
So the directive for our Talk Tickers audience is clear. If you are managing a position in LVS, you have to look past the noisy headlines.
Ignore the noise.
The temporary margin compression from aggressive OPEX hiring, the quarter-to-quarter statistical variance of a $15 million baccarat loss, the logistical headaches of the Venetian renovations, this is all just short-term turbulence on the radar.
Just bumped along the way.
The underlying reality is that this twin-engine jumbo jet is generating massive, resilient cash flow, and management is ruthlessly deploying that cash to buy back equity and enrich the remaining shareholders. It is a textbook scenario of tolerating short-term transitional friction for long-term compounding gain.
The structural advantages they have built, the scale, the regional monopolies, the capital return program are incredibly difficult for any competitor to replicate.
Absolutely. Now, before we wrap this deep dive up, I want to pivot back to one specific operational detail that I can't stop thinking about. It's that barbell betting strategy, the side bets.
The gamification of the VIP experience.
Right. We have an ultra-wealthy demographic, the most capitalized individuals in the global economy, and when they have the option to deploy capital into mathematically sound, low-volatility strategies, a massive subset of them are aggressively choosing the opposite.
Defying logic.
They are willingly accepting terrible mathematical odds, paying a massive premium to the house, purely to experience extreme, concentrated volatility.
They're paying for the dopamine hit of the variance.
And it forces you to ask a much larger question about consumer psychology and the broader economy. If the absolute wealthiest individuals are bored by safe math and predictable returns, what does that signal for the rest of the market?
That's a scary thought.
We've watched this play out in the retail sector with the explosion of meme stocks and the manic volatility of cryptocurrency trading. Now we are seeing the exact same psychological profile driving billions of dollars in volume on the baccarat tables in Singapore. Are we transitioning into an economic reality where a product, whether it's a financial instrument or retail trading platform or a luxury resort, can only sustain engagement if it artificially engineers extreme gamified volatility?
It is a profound shift in how risk is priced and consumed. If the utility of money is no longer about accumulation, but about the entertainment value of the risk itself, every industry is going to have to adapt its product offerings to capture that demand.
It is a dynamic that will dictate consumer behavior far beyond the casino floor. Something to keep in mind as you assess the risk profiles of the companies in your portfolio this week. Dig into the numbers, read the footnotes, and watch how companies are manipulating volatility to keep the modern consumer engaged. Thank you for joining us on this deep dive.